Yeah, it's great to have you on the show, Brian. I just think it's been a remarkable last 5 days. You had a very hawkish Fed, you had an even more hawkish ECB, and now you have the BOJ. And obviously, as you mentioned, rates around the world are going higher. There's really no change in my thinking that rates are going to stay higher for longer. Excuse me. Someone's calling into the show. There's no change in my thinking. Rates are going to stay higher for longer. Growth is going to slow. I don't know if it's a recession or not, but we also know that earnings are likely to come down. That being said, the good news is actually we have some momentum in the economy right now, right? I mean, we have strong jobs. We still have more job openings than unemployed people. And I know those numbers are peakish, but it's still the fact. And wages are going higher. Input costs are coming down. So I think we're at a position of strength, stronger momentum in the economy so that we can handle higher rates and higher for longer. Again, that doesn't mean that we're not going to slow down or we could see a recession, but I just think that we're in a lot better shape than is being portrayed at this very moment. And so at the same time, you have a S&P 500 down 20%, a NASDAQ down over 30%. A lot of bad news is factored in. So no real change. I think we can rally into the end of the year. We're going to probably trade around for a while in the first quarter until we can kind of see and get our footing on where rates and what rates are going to actually do. But it's not all doom and gloom.
No, it's not. And, you know, why don't we have an optimistic Tuesday? And Josh Brown, I saw a post by a guy named Josh Brown who was just throwing out history. And it was basically the S&P going back, I think it was 100 years. And I think you made the very smart and salient point historically that, listen, doesn't mean it won't happen, but it's pretty doggone rare for markets to go down 2 years in a row. I mean, there is a little history on our side.
Yeah, and you can play with the numbers. You can use different data sets, but a lot of people are trotting that out because it is a down year, and down years are pretty rare. So the most common version of this story that you'll hear is 21 down years for the market. In 18 of them, the follow-on year was positive. What happened in those other three? Pretty extraordinarily bad recessions. What's really interesting, though, Brian, when you talk to bears, and I'm like a little bit bearish, but when you talk to bears, like hardcore bears, one of the things that you'll hear over and over again is that earnings are going to be down next year. They're already down this year, so we know. Like if you pull out energy, S&P earnings are down. Like that should not come as a surprise to anyone. And estimates for 23 have been coming down pretty much every month this year, very steadily, almost monotonically. So this is like a well-known negative. We're all aware of it. I don't think it's going to be easy to make money next year. I think you'll have pockets within the market where companies have a secular growth story happening, things like solar, areas of healthcare, select areas of energy. But overall, it's going to be tough. And this year was tough. And, you know, even if you go by the historical probability, only a 9% chance historically that next year is also down, doesn't mean next year has to be back up 20. So we've had a rough year. Next year could also be rough. We've had rough years in recent history. People tend to forget. In 2018, the S&P was flat, but we had two separate high teens drawdowns, almost full-blown bear markets, bookending that year in February and in December. So you could have a flat market too. The right answer might not be up or down. And I think what most people want to do out there is build a portfolio that is durable enough to withstand any of that range of outcomes and not anchor to one particular forecast, good or bad.
Yeah, in the forecast, Jim, and again, I'm not going to throw any strategists under the bus. They're all our friends. People make mistakes, right? They come on this network and talk about it. But if I'm looking at 25 strategist target from this time last year, looking at this year, the low, as we know, was Mike Wilson. The median forecast was for S&P 48.75 and $230 of EPS. So everybody was pretty spectacularly wrong unless we get some massive rally in the next week and a half. Now, Jim, everybody's tripping over themselves to be negative and bring their forecast down. And I wonder if that sentiment would flip it.
Well, Brian, I like where your head is on this. And, you know, I'll start by saying that predicting the future is in some way a fool's folly, you know, and doing it a year out is pretty hard. So let's not go a year out. Let's go maybe a month or two out.